So I'm very happy to meet today to Dr. A.V. Turetsky. He's partner, Landmark Partners. It's an areas company, and I'm very happy to see you because we have a long discussion and talks just before you fly to Germany to prepare our interview. And it was very, very interesting to learn about your idea to present yourself and your strategy here in this area on the Alternative Investors Conference. It was funny, I can promise the audience. And maybe we start to introduce you. Please say a few words about you, who you are, and what you do.
Sure. So I am Avi Turetsky. I'm a partner at Ares. I came over to Ares when they acquired another firm called Landmark Partners in the middle of last year. I'm a partner in our quantitative research group, one of the heads of our quantitative research group. So I'll say a bit about secondaries. The secondaries market is a part of the market where we acquire, or firms acquire, traditionally large portfolios of assets. So if you are, say, an institutional investor with a 300 million euro portfolio of private equity assets, we'd be someone who would buy that. More recently, what we were talking about today is GP-led transactions. This is a newer part of the market where secondaries firms will provide liquidity to a primary private equity firm. Could be to a single company, could be to a portfolio of companies, or could be to the asset manager themselves. So a lot of interesting things that we spoke about, I think.
Your presentation today was about fees and the fees on GP-led versus traditional secondaries. What are some of the conclusions?
Yeah, so we think this is a very interesting area. One of the things that we do on our quantitative research team is to model fees. We think it doesn't always get a lot of attention, but there are some interesting and counterintuitive conclusions. So one of the things that we found is that the fees on GP-led transactions, because of how they're structured, can provide some interesting defensive characteristics relative to traditional buyouts. We found specifically that because traditional buyout funds tend to charge something like a 2% management fee on committed capital and then 20% carry, in a GP-led secondaries fund, you can get often a more beneficial fee structure because secondaries funds tend to charge less. It's a 1% management fee and 10% carry. And then on the underlying investments, you're paying just on invested capital, not on committed capital.
Avi, I learned that you work in a quant research. Tell me more about the role of quant research in private markets. Not many firms have that function, do they?
Yeah, it's something that's not that common, I don't think, in private markets, but definitely growing. This started in the case of Landmark, or now Landmark Ares. It started around 2009 when we realized that we were building secondaries portfolios that could have a few hundred to even a few thousand companies in them. And when you have portfolios that are that diverse, some of the same tools that public market managers will use quantitative research for become very applicable. So I'm thinking of things like factor exposures, diversification, balancing alpha versus risk within a portfolio, balancing alpha versus diversification. And one area that's become very interesting to us recently is fees, which is the topic that we've spoken about today. So now at Landmark, or Landmark Ares, in our quant research group, we're about 25 people that works on original research. We do that together with GPs, LPs, and with the academic community. We also have a software team that takes what we do and turns it into original software tools. And in general, we have a lot of fun and I think also add a lot of value to our firm and to our counterparties.
Yeah, it looks like that you have to invest a lot of input, money, human capital and so forth to build up this. Is it a USP? Can you say that in this way?
Yeah, I think so. And it's It's funny how you talk about that, investing money, investing resources in it. That's definitely true because we're a group of people that does a lot of work. I think you find a couple things. One is that if quant research is done well, it can help to improve returns, obviously, because you're finding signals. You're finding, for example, whether a manager has been able to create alpha, to identify different ways that managers create value, different ways to identify value going forward. But it also can be a cost-saving element as well, because having good quant research can also help to make you more efficient in how you invest.
You start here to present yourself. Do you have any thoughts or experiences? Are the people here, the institutional investors in Germany or in Europe, open for your ideas?
Yeah, we find that a lot of people, many people are very interested in the insights that can come out of quantitative research. So one example, the presentation that I was giving earlier with another colleague of mine was on the topic of in-depth analyses of the fees of private market funds. And we use some pretty sophisticated tools, some pretty complicated tools to analyze how fees change the outcome of funds, the returns, the revenues to a GP, the costs to an LP across different economic environments. We find in this case, we had some very good attendance, some very interesting questions. We also find in general that especially investors who have a background in public markets and are familiar with the types of quantitative tools that are used in public markets, it often clicks. It makes sense to them to see the same types of tools used in private markets. And that can lead to some very interesting conversations. So we will often have conversations with limited partners about portfolio construction or benchmarking their portfolios or identifying alpha within their portfolios. So the answer, I've said a lot, but the answer is yes. We find that there's a lot of interest from investors in this type of work.
I cannot let you go, dear Avi, to talk about impact investing, ESG. It's all about this topic here in Germany, even here on the Alternative Investors Conference. It's very important because we have a global problem, the climate change, and now the war, hunger, all over the world, the heat in India. So that is more fundamental. It's globally. So let's talk about this topic. Could your strategy, your quant research help to generate alpha, for example?
Yeah, so ESG is a very interesting and obviously very important area. And it's an area where we and other people who we work with are doing, I think, some interesting work. So for example, private infrastructure is an area where I spend a fair amount of my time. And we've worked together with academics, we've worked together with other large institutional investors on classifying private infrastructure investments. This is together with a group called the EdHec Infrastructure Institute. One of the newer types of classifications or types of systems that is being looked at is ESG. Because ESG is something that is clearly very important to investors. It's also not always straightforward to define what good ESG is versus not as good ESG, and to separate the environmental and the social and the governance. So this is an area, here I'm speaking within quant research, it's definitely an area where we're interested, and it's an area where we and people who we work with are spending time.
And I'm sure it will work, because the taxonomy here in Europe, and you have to research, you need data and analysis, and so it would
that's
fit
exactly
perfectly to
that's
your work.
exactly the aim, right? To try to make things more tangible, more quantitative.
Dr. Avi Turetsky, partner of Landmark Partners, I'm very happy to meet you here and hope to see you back here in Germany to make the next interview. It was very interesting, and thank you for your thoughts and for your insights regarding to your speech. Thank you for today.
Thank you very much, and likewise.